Joining me right now is Bulltech Capital Markets Chief Strategist Kathryn Rooney Vera. Kathryn, kicking things off with you with a market that is in the green this morning. Investors betting perhaps that inflation may have seen the worst at this point, but you say it will get worse before it gets better. Tell us why, what you're seeing, and what the Federal Reserve is thinking now as it kicks off this two-day meeting. You look at the Fed's impact on fixed income ahead of this meeting.
Absolutely. And the markets, especially the fixed income markets with U.S. Treasury yields at 150, when you have nominal GDP growth rates of 11% and you have massive economic robustness and inflation topping 6% with a red hot labor market, really scratches your head. You really scratch your head as to why the Fed is still so enormously expansionary. The Fed has promised and indeed is tapering, which means that, of course, they're buying fewer bonds. They're not selling bonds. They're buying fewer per month, and they're going to end tapering in June and start to hike rates. The Fed is following the markets. This is a Fed that is very reluctant to precipitate the next economic downturn by basically trashing the markets. And the way they do that is following Fed funds futures. Fed funds futures say they can go twice next year. So the Fed will probably hike twice in the end of next year. My biggest concern next year, Maria, is inflation, not COVID. It's Fed policy risk. Could the Fed get it wrong? And the market is pricing in that the Fed is going to get it spectacularly right. But where could the Fed get it wrong? One of two ways. One, they just don't care. They give inflation a pass. Inflation could go higher before it gets better. Base effects are going to improve inflation. That means inflation is going to come down because this year inflation was so high by the end of next year. But what if it doesn't and the Fed stays very inappropriately accommodative? The market will lose credibility with regard to the Fed and its inflation fighting credibility, and that's the worst thing that can happen. The other thing that could happen, of course, is the Fed realizes that it's behind the curve on inflation, which is 2 to 3 times its target, and in fact we do have full employment. And the Fed has to launch rates. If the Fed launches rates, goes more than the market expects, then we should expect risk assets to tumble, and we should be long gold and land and all of these defensive, protective assets that we've talked about in the past, Maria.
Yeah, I mean, do you want to do anything different, though, ahead of this Fed meeting, I guess is the question, Kathryn. We know inflation is running at a 6.8% annualized rate. We know that there are valuations in this market that are sky high, particularly in big tech. Do I want to change my portfolio going into the Fed's changes or the shift in policy?
Yeah, you want to add to those defensive positions. You want to own gold just in the risk that the Fed does allow inflation to spiral out of control. You want to hold land. You want to hold hard assets. You want to own real estate. You want to own defensives. You want to own healthcare. You want to own industrials, materials, banks. You want to own, Maria, those sectors that are both rate sensitive, so when rates go higher, they benefit, and inflation sectors, so that when companies can pass along those costs, or they can even make money off an inflationary scenario, because maybe the Fed has got it right, but maybe the Fed has got it very, very wrong. So that's where I think we need to position and hedge our positions at a minimum going forward.
Had a huge year. All right, we'll be watching. Kathryn Rooney Vera, Brian Bendig, Michael Lee. Great to see you all. Have a good Monday. Thanks very much for the great word on Wall Street.